and some pretty remarkable work. And finally, in a very timely way, it's Yankee slugger Juan Soto's birthday. The man turns 26. He's going to be playing in the World Series tonight for the Yankees. And as a 26-year-old after the season, I think he's going to get a $600 million contract.
That is quite the sum, isn't it?
That's amazing. I mean, we're probably the second highest contract in baseball after Shohei Ohtani's amazing $700 million. But Ohtani also pitches, so we've never seen a guy like him. But it's great to be 26 and looking at $600 million.
Yeah, and speaking of which, will you be watching the game today?
Oh, absolutely. And I think watching every game. I'm a long, diehard Yankees fan.
Yeah, we'll be keeping an eye on that game that starts around 8 p.m. this evening.
Right.
But before we get to that, let's start out with a look at the market.
Yes.
So this morning we're seeing green across the board for the major U.S. stock averages, and this does come after the volatility we saw this week. On this Friday morning, we're seeing the Dow up by triple digits, up by nearly 0.3% on the session, while the Nasdaq is extending gains today, up by over 1%. Or currently up by 250 points. And we'll talk about Tesla, but we saw that surge in Tesla shares in the previous session helping to boost the NASDAQ. And finally, let's look at the S&P 500, which is higher on the session, up by about 0.8%. So we got a slew of economic data this morning, but I know that ahead of next Friday's jobs report, we should take a step back and look at jobless claims that came out yesterday.
The claims number, I think, surprised a lot of folks. We didn't get a chance to talk about it yesterday, but 227,000 versus 242,000 expected. It seems that sort of hurricane bump didn't last very long. It really lasted functionally a week, maybe a week and a half if you count the week right after that, and now we're sort of back to normal. I think that makes the market sort of a little bit happier. And also, this morning, the durable goods came in more or less on expectations. It's a very cyclical report, and we're just in kind of a quiet period right now. But just before the show was started, we had Michigan. And the Michigan report was really kind of a Goldilocks report. Inflation expectations were lower, but confidence was higher. So suggesting that perhaps the market is feeling better about the Fed starting to cut rates and the rates will be coming lower. And I think that sort of that's a report that makes the Fed happy, and hopefully continuing their measured cuts. I think the 95% of people have a 25 basis point cut baked in at the November meeting, and that is making the market happier. And the S&P looks like it may close strongly today and kind of dispel the gloom that we had sort of in the middle of the week.
Yeah, and I'm glad you mentioned that, because this week we were seeing red across the board. We saw a mixed close, many sessions this week, but here we are on Friday, and depending on how high we close, we may possibly see a higher close for the week. But as we head into next week, we have to keep in mind that it is month end. Hard to believe only 4 full trading sessions left until the beginning of the new month. And given all the volatility we've seen, there's a lot to look forward to.
There's big tech earnings reports next week. You mentioned Tesla.
Yes.
Tesla really beat everywhere. And I mean, Tesla still has issues in terms of slowing EV buying in the U.S. And other places as well. But they beat everywhere, and I think there are a lot of Elon haters out there. There have always been. Many of them have been carried out, but now I think there are even more, because there are a lot of folks who actually probably the segment that likes EVs probably can't stand Elon's politics right now. So you're getting a lot of shorts, and I think a lot of shorts are getting carried out. I mean, up 20% yesterday. I think you mentioned they were up 3.5% again today. If you're short and you're leveraged, that's incredibly painful, and that's what this price action suggests to me, that there are some shorts who really just caught on their back foot. They probably were pretty happy after the Tesla drop, after the robo-taxi thing sort of fizzled and it wasn't up to expectations. But this is a very painful reminder that sometimes it can be really tough shorting Elon Musk.
Yeah, and in New York morning trade right now, we are seeing Tesla shares maintain gains up by just 0.7%. But as you mentioned
Right.
earlier at the open, Tesla shares were higher, up by over 3% on the session. And as you mentioned, it came on the heels of the rally we saw yesterday.
Right.
So
Right.
that is significant. But we do have other tech earnings coming out next week. So what are you excited about ahead of those earnings?
It's, I think those earnings are there's, the expectations are reasonable. I don't think they're sort of extreme. So not expecting a huge surprise.
Okay.
I think if we do get a surprise, one way or the other, it could substantially move the markets. I think markets are probably paring. I think a lot of investors are paring back their risk ahead of a jobs report, ahead of the election, and ahead of the Fed. So probably more susceptible to any surprises one way, sort of one way or the other. With tech, I think maybe a little more susceptible to a downside surprise than really an upside one. But I think the risk is getting pared back a little bit, even though the S&P is having a pretty good day.
And I think another name we should focus on today is Boeing. So we are seeing shares of Boeing up by about 0.5%, but we weren't able to get too much into Boeing this week.
Right.
So what do you think is going to happen with that company?
So that's the machinist Wednesday night late rejected the latest proposal, which is 4 years and 35%, which is functionally what they asked for, by a 64 to 36%. So basically 2/3. And at this stage, I think they want their pension plan back. So their pension plan in 2014, if you had it, you got to keep it, but they would no longer add to it. And they wanted that back. And I think this is one place where they're not going to get it. And the reason is that this became very popular sort of in the middle of the 20th century when car makers like GM and other companies wanted to keep workers, and they gave them tremendous defined benefit pension plans, which means you get a pension after you retire for the rest of your life, which could be a really long time. And it's great when times are really good, but as GM found out, as we went into the 80s, 90s, and 2000s, it's like having a $100,000 house with a $500,000 mortgage on it. In fact, it was so bad that no one would buy GM. When GM was forced to file for bankruptcy in 2009, right after the pandemic, their unfunded pension liability was $14 billion. Right now, Boeing's unfunded liability on that is believed to be somewhere in the neighborhood between $5 and $6 billion. Now, Boeing's a different business than GM. They have a much bigger moat. Really, it's them and Airbus for now. But there's no way that I can see the CEO or the board of Boeing saying we're going to bring that back. We'll give you other things. We'll increase 401k contributions, which are great. But once we've given it to you, that's it. We have no more responsibility. You just don't want to carry something like that deep into the future. So I think they want it, they won't, but they won't. The strikers won't get it. And I think it's who blinks first, right? The strikers were heading into the holiday season in the state of Washington and in most states. You don't get paid unemployment benefits when you're on strike, and that's going to start to hurt. Boeing is hurting too, but I can't see the CEO backing down on that. I mean, at some stage he may go 440. Here's what you wanted. Are you still going to strike? But I think now it remains to be seen where who gives. But the defined pension plan, workers love it, but I can't see it coming back.
Okay, well, as we head into the weekend, this does mark week 6 for the strike, and that is considerable, as you mentioned, not just for the workers, but also for the organization. And we've also talked about the suppliers as well and how it affects them. So overall, there are concerns about a potential credit downgrade, and that could have implications on Boeing as well.
Absolutely, absolutely.
Yes, and now I do want to move on to other stories that we're watching today. Since we're looking at companies, let's talk about what we're seeing in commodities, but also Newmont shares. So in New York morning trade, shares of the company are lower today, but tell us what's going on here, and do you think this is an overreaction?
Well, let's look at graphic 2, because I saw this chart and I just wanted you all to be as sort of surprised as I was. Graphic 2. This is yesterday's chart, the close. So Newmont came out and sort of missed on earnings a bit. I think the revenue wasn't where the market wanted it to be, and it had enjoyed a huge rally through the course of this year. Look at that red bar. I mean, that red candle. I've got a scientific term for it, and it's like, yee! You get that, and you're like, wow, that's really painful. That's the market being quite long, and you're seeing stop losses cascade. I think they opened lower again today, but they're a little bit flat. So one of the things that I think the market really was distressed about was their all-in sustaining costs, which is what it basically needs to keep mining and get an ounce out of the ground. It went up 13% year on year for the third quarter, from $14.26 to $16.11. And this is one issue that it always worries me about the miners. Mining is a really tough business. I mean, you have to build a mine, permit it, it takes you the better part of 10 years to get it going, and then from time to time you have to do maintenance. You might get accidents. We just saw that Vale, we have the board right here. Vale was halted for trading because their earnings were out, and they missed tremendously because of damages associated with a tailings dam, I think, that broke. So it is really hard to run a mining business. So sometimes I really think that it is simpler to buy the commodity and not really deal with the mines. Now that said, the mines have done great this year on gold because gold has gone up so much, and looks like it'll continue to go up. So I do think, even though we looked at that and it was really kind of an ugly candle, you might be able to buy this one on dips, but it hurt the other miners as well, because people were worried, is this a signal of what else is to come? Because the royal people, when gold rallies like this, the countries will demand more royalties, and the workers will demand more pay, and your mine is in their country. You basically have to play ball, so your costs can go up very, very quickly in mines, and so Newmont showed us that yesterday.
And I'm glad you brought up the point of gold, because when we're looking at gold prices right now, we see record highs for the front month contract. When we're looking at the COMEX contract as well for gold, it is above 2,700, and that is something that we've highlighted when we're talking about central bank holdings of gold as well. But in terms of implications for the miners, is there any, and what does it mean?
So I think this looks like it's going to be a one-time problem for Newmont. I mean, you certainly don't want to get into issues where you have recurring, non-recurring problems. Right? This should be a non-recurring problem. They think their all-in sustaining costs will go down the next quarter, go back down to something more reasonable, like $14.75, which the market is okay with. But the costs never go down; they only go up. The price eventually will consolidate and may correct. It's a great year so far for the miners, for the mining ETF, as it should be, a gold year like this. Gold looks like it'll continue. Silver is stalled out a little bit. On the Heiken Ashi charts that I like for silver, looks like it's stalling. So I think that's worth a speculative buy, but maybe a little bit lower. And the problem with silver is it can really do very well, but you could turn around and lose 10% in 2 or 3 days, which is, for many investors, I always say, if you want to invest in gold. If you want to play and speculate and go to this casino, that's silver. The other thing we should mention is palladium, which is generally in that complex. It's part of the PGMs, and the other day, the Biden administration went and recommended that perhaps the G7 should clamp down on Russian exports of palladium and titanium as a response to the war in Ukraine, that sort of tightened the screws a little bit. Palladium, 40% of the supply comes from Russia, and that went up 9% yesterday. It's up again today, and just like Tesla, I think this is a case where the shorts have been caught very, very badly. Speculators have been short palladium for a long time, have done very well. As a matter of fact, that December last year, palladium rallied tremendously on on some technical issues with the contract and deliverability, went up $200 almost in a straight line, and the speculators pressured it back down. So you might be seeing a little bit of that right now. Now again, this is just a recommendation. It's not that it's going to be policy anytime soon, but nevertheless, if you're caught short, palladium is a very illiquid market on a good day.
Yeah.
So that's why you're seeing the market, the sellers, I think, well, we're not sure what's happening. We're not going to sell any more here. We want to wait for things to calm down. So I think we're seeing actually a lot of catalytic converter business come into the palladium market over the last couple of days, simply because palladium has gone up so much, and those dollars matter to folks who recycle those converters.
And I think we're seeing interesting price action when it comes to the precious metals. So you highlighted gold as well as silver, palladium. We'll keep an eye on what happens moving forward with all of these precious metals. But in terms of what we're seeing, why does gold continue to hit these record highs despite everything that's happening?
So I think the biggest reason is it's been driven, the sentiment has been driven by central bank buying. And it's a central bank buying mostly from sort of, I guess, third world central banks that are concerned that with how the West froze $300 billion of Russia's money, in retaliation for their invasion of Ukraine, it is the reserve currency. We need to be in it. But if we can move, dollars, quote unquote, elsewhere into something like gold, that's worthwhile. And they finally defeated folks. So there are a lot of anti-gold bugs who've been pressuring gold over the years and have done pretty well, but they've really cleaned those out. If you're a gold short, you've been carried out, cremated, and your ashes, buried or scattered somewhere. So there are really no gold bears right now, which is generally, you worry about that as an investor, but the price action, doesn't lie. There's just the supply is coming from the miners, and the miners aren't even hedging. The miners haven't hedged really in any substantial way since I think 2200. I understand some of them are looking for 3,000 to hedge. I think that would be a wise thing to do. You want to be able to lock in 3,000 plus the forward, whatever the forward is, out 2 or 3 years, because you don't know what will happen. No one knows what will happen in 2 or 3 years. So I think around 3,000 or maybe ahead of 3,000 we may stall out a little bit. But it's a bull market, and like I said, I'm long, but I wish I were longer.
Yeah. Well, of course, we only have about 7 minutes left for our market segment. So I do want to talk about the upcoming election because the countdown is on. And we're keeping a close eye on polls. All the polls, or depending on who you are, you might be watching certain polls across the nation, whether we're talking about certain demographics or certain states, battleground states. But tell me what you're seeing right now.
So let's take a look at graphic 3, because I think at the end of the week, and we'll do this again at the end of next week, right ahead of the election. So the best way to look at the polls, because there are so many and they differ in quality, and unless you're Nate Silver or 538, it's hard to really discuss each specific poll. So the Real Clear Politics gives an average of the polls on a running basis. So if we look at the upper right-hand corner with the red and the green, it looks like Trump has increased his lead in 5 of the 7 swing states over the last week, while he's lost a little bit of his lead, but he's still leading in North Carolina and Michigan. So he continues, according to the average of polls, hold leads in all of the swing states. And if we look at, if history is any guide, that is going to make him more likely to make it to be the next president of the United States. So one thing that I did, all this is some Real Clear Politics, but one thing I did do, and if I have time, I'll get into it a little bit right after this, but on the right-hand side, that little box with Trump wins, Senate GOP, House GOP, is something that looking at all the different polls and the status of the races, I'm giving Trump a 55% chance to win. Now, I might be a little low on that, but the reason I've done that is the Democrats' ground game has always been tremendous. They have hundreds of people out in Pennsylvania. As a matter of fact, I think 100 people flew over from the UK, from the Labour Party, to help out Harris in the swing states, which I think is a little bit risky, because if the other guy gets in, he's going to not be happy with it, right? You just hope he forgets about it. But I give him a 55% chance because the ground game is still, the Republican ground game has always been trashed, and it's not good this year. Then the Democratic ground game is great. So I'm giving him a 55% chance. The Senate GOP, people are pretty sure that the Republicans will retake it because West Virginia, Manchin retired, so that's going to the GOP, and it looks like Montana will go the GOP's way as well. But there are a couple of races that are a little close for comfort. In Texas, in red Texas, Ted Cruz is holding on to a 3 or 4% lead. Could they flip Ted? Maybe, probably not, but possible. And then in Nebraska, quietly, this independent named Dan Osborne has crept close to Deb Fischer, who's the sitting senator. So if the Democrats can flip either of those seats, or if Tester somehow hangs on and Harris wins, they will have a 50-50 split and hold the Senate. The House, there's too many races, too hard to know. I think their first-term House incumbents in California and New York, they're particularly vulnerable, so I give the Democrats a very small edge. So at the bottom, people have been talking about what will happen if there's a sweep, if there's a red sweep. So if you actually just simply take the numbers, the theoretical, if you multiply 55, 75, and 45%, your theoretical value of a red sweep is about 18%. But really, it's higher than that. You give it 30 because they're not independent races. They auto-correlate. So if Trump wins, he's going to probably have pretty big coattails. For example, if Trump wins, it's hard to see Ted Cruz losing because how many people in Texas are going to vote for Trump and then vote for the Democrat in the Senate? That seems pretty unlikely. Similarly, if Trump wins, then he probably has coattails that helps the House races. On the other hand, if the polls are wrong like they were in 2022, with the red wave that became barely a red ripple, you'll have Harris dragging, potentially bringing the Senate with her and almost certainly bringing the House with her. That's why, even though in theory the chances of a blue sweep is about 7%, I'm actually giving it a 25% chance. Probably a little high, but again, these things auto-correlate, which is pretty important.
Yeah, I think it's very important that you mentioned the correlation and the auto-correlation as well. And we know that both candidates, as we edge closer to Election Day, they're both making their last-minute pushes. And apparently Trump is scheduled to tape an appearance on the Joe Rogan Experience in Austin, Texas. And I believe that it's possible that Kamala Harris might not be able to make it in time given her conflicting schedule, but a lot is happening here.
So what's really interesting, so I think it came out that Kamala will not be on the Joe Rogan podcast, and Trump will be. And I think Rogan is kind of a maverick, and he has, I think people who listen to him are probably more Trump supporters than Harris supporters, and he has really long podcasts.
Yes.
They're like 3 hours long. So I don't know how long President Trump is going to be on it, and he's probably preaching to the choir. But I think there is some risk there that I wouldn't I guess the word is denigrate or too much, because if you let Trump speak for 3 hours, the likelihood that he says something dumb is really extraordinarily high, probably asymptotically close to 1. So I don't know if this is actually a good move. If you're doing well, you're riding a wave, I know he'll talk to anybody who wants to talk to him, but I think there is some level of risk here.
That'll be interesting. So perhaps next week we will be talking about what we heard from that experience, and I think this is something that supporters of both parties may indeed tune in to listen to.
Yeah. One thing I would add, actually, that came out relatively late, but we have a little time, is it came out that the standing committee of the Politburo of China, and those are the 7 guys led by Xi who really matter. They make all the decisions. They've called a meeting from November 4th and November 8th. And I'm saying they're probably just getting together to settle their bets on the election. But in truth, I think they're going to see the results of the election and decide what they want to do if they need to actually bring out that bazooka of fiscal stimulus, because Trump in the White House is going to make life fairly difficult for China, more difficult than China than it has been.
I'm sure the scheduling of that gathering is deliberate and not a coincidence.
I think you're absolutely right.
We will see what happens as we head into the month of November. But Tai, as always, thank you so much for joining me here at the New York Stock Exchange, and have a great weekend. And coming up next, I will be joined by Dan Ha, partner at Karani Asset Management. We'll be right back. Don't go away. Welcome back to Global Money Talk live from the New York Stock Exchange. Only 4 more full trading sessions to go until November 1st, with only a handful of days until month end and a new month with highly anticipated events that will set the stage not only for the short term but also the long term. From the election on November 5th to the Federal Reserve rate decision on November 7th, the countdown is on. Joining me for today's market insight to provide perspective is Dan Ha, partner at Karani Asset Management. Dan, happy Friday. Great to have you back on the show.
Happy Friday. Thank you.
Well, 2 weeks since you were last on the show, and a lot has happened over those trading sessions, a slew of earnings as well as plenty of volatility across some key sectors. So what has stood out to you, and what would you like to share with our audience?
Sure. I guess over the last 2 weeks, the most provocative thing that I saw was Goldman Sachs's prediction of the S&P 500 returns over the next 10 years at 3% annualized. 3% annualized for 10 years comes out to be something like 34% total return over that period, over a 10-year period, which is a lousy return. And I mean, who knows? Maybe Goldman will be right, and maybe that's what we get. Maybe they'll be wrong. And to be fair, they did present a range in that report of between -1 and +7 over the next 10 years. That was their forecast, and 3% is about is the middle point of that. So who knows if they're going to be right? But I thought when I saw that report that the logic that they applied was really sort of worth following. and the reason why they make this prediction is really, there are multiple factors, but largely driven by two things. One, valuation, and second, the concentration level of the S&P 500, the cap-weighted S&P 500 to be specific. So first, the valuation. What's the issue with it? Well, before we talk about the valuation levels of the S&P 500 today, it's important to just remind folks that valuation, all else being equal, when you pay high price, that's going to eat into your returns. Meaning, if you pay a high price, it's going to reduce your rate of return, all else being equal. That's just math. The S&P 500 right now, the metric that Goldman Sachs was looking at for this particular report is what's known as the cyclically adjusted PE, or the CAPE. And the difference between the CAPE, the cyclically adjusted PE, and the regular PE is that the CAPE looks at today's price relative to the average earnings of the last 10 years. So it tries to smooth out the cyclicality in the earnings results of the companies, whereas the S&P 500 is, the regular PE is often looking at price divided by, say, last 12-month earnings or the next 12-month projected earnings. The CAPE measure for the S&P 500 is currently at 38 times. To put that into perspective, 38 times comes in at the 97th percentile of that reading, going back to 1930. So the current PE, cyclically adjusted PE, is basically at around record highs of the last 100 years. So we're starting at a very high point, which, again, all else being equal, will reduce, or ought to reduce, the rate of return going forward. Now, what makes investing difficult is that you can't just look at PE and predict that, all right, we're going to have good returns or poor returns. If that were the case, everyone would make money and avoid losses, right? There are plenty of periods over the last 100 years where market traded at a high PE, yet the forward 10-year returns of the index was robust, and vice versa. So you can't just look at PE, but that's one of the factors, or that's one of the reasons that they cite for their sort of return going forward. The second is concentration. So, I'm sure we've all heard about how concentrated the S&P 500 is. The point about that is, the important thing about that is, historically, when the S&P 500 is that concentrated, usually what followed were periods of pretty poor returns. Right now, the S&P 500, the 10 largest companies in the S&P 500 make up of something like 36% of the overall index. Those 10 companies, these numbers aren't super fresh. They're a couple of months old. We ran it at our firm. Those 10 companies, their earnings collectively is about 28, sort of high 20s percent of the aggregate earnings of the S&P 500. So their market cap is in the mid to high 30s of the aggregate S&P 500. Their earnings share is high 20s of the S&P 500. What that means is that clearly the market expects that those companies their share of earnings will continue to grow over time. Because if not, if the expectation is that the earnings wasn't going to grow faster than an average S&P 500 company, then the market share, or the market cap share, would be about the same as the earnings share. So the market is expecting these companies to continue to grow faster than a typical S&P 500 company. And in order for that to happen, what do you need? You basically need to have continued robust revenue growth out of these companies, as well as high margins from these companies. Historically speaking, maintaining high growth and high margins for the largest companies is just very difficult. So this time it could be different, like the current 10 or some, those could be the, the winners over the next 10 years, continue to be the winners. But if you're making purely that bet, then you kind of do have probabilities against you, stacked against you. So, those two things are the reasons why Goldman Sachs predicts that the S&P 500 returns over the next 10 years is going to be quite lousy.
And Dan, I think it's so important here to make the distinctions that you did in order to understand what's going on here, because if you see this headline from David Kostin, the Goldman Sachs chief U.S. equity strategist, with his 10-year market forecast, you might just think, oh, is this a reason to panic? And initially it might sound depressing because, as you mentioned, the year-to-date gains that we've seen in the S&P 500 this year are considerable, over 20%, and even when we're looking at the equal weight for the S&P 500 year-to-date, we're up about 15%. So while on the surface this might sound depressing in terms of the forecast from Goldman Sachs, what can one do to prepare under this assumption here?
Sure. So first of all, Goldman's recommendation, therefore, is to focus on the S&P equal weight as opposed to the cap-weighted, the normal S&P 500 that we all know of. And that is because, obviously, if your prediction is that the S&P 500, the regular S&P 500, is going to deliver lousy returns over the next 10 years, and S&P 500 top 10 make up about a third or more than a third of the S&P 500, the value of the S&P 500, then by definition, you're implying that those largest components will underperform the rest over the next 10 years. So if that's the prediction, then you want to focus on the rest, and the way to do that is by investing in the S&P equal weight. There are a couple of other ways that this could play out. So first of all, they could be wrong, but let's assume that they'll be right. Even if they're right, there are a number of different ways that this plays out. So like I said, the largest guys could underperform and the smaller 490 could outperform. That's one way this might happen. Another way that this might happen is that everybody just kind of slowly and gradually appreciate more or less about 3% a year over the next 10 years. That is very unlikely to be the case, but if something like that happens, what you want to focus on is probably growth. What I mean by that is, if you're expecting sort of a lousy or sluggish equity return environment in general, what you probably want to have is growth, because companies that are growing are going to be the ones that actually power through that sluggishness and deliver outperforming results. And in order for you to, when I say growth, to be clear, I mean earnings growth. But in order for you to have sustainable earnings growth, it's kind of hard to do that without sustainable revenue growth. So basically, to put it really simply, you want to look for companies that are healthy and that are growing healthy. And by growth, I don't mean just like high-flying, high growth, growing 20-30% a year type technology companies. A consumer staples company that's growing, say 8-9% a year in an industry that grows mid to single digit, that's plenty of growth. That's very healthy growth. So, certainly by no means am I saying if this is the scenario you predict, then buy growth at all costs. I'm not saying that at all. You do have to pay attention to valuation, but you do want to, for the next 10 years, if you're looking for a company to own for the next 10 years, you do want to look for companies that are going to sort of sustainably grow over that period. Another way that this future, this 3% growth appreciation of S&P 5, total return of S&P 500 over the next 10 years, another way that this happens is that at some point that the market actually corrects meaningfully. 3% yield on the S&P 500 is not enough of a return. What is the proper equity discount rate is a debate that'll probably never end. No one can really tell precisely, but I think most will agree that 3% isn't it. Like 3% is way too low. So then what needs to happen for the equity market, for the S&P 500 to deliver better than 3% returns to the investors? Well, price has to go down significantly. And whatever you think the proper equity discount rate is, if the right number is somewhere between, say, 7 to 10%, just looking at, equity returns historically, under that scenario, S&P 500 from this point would have to fall somewhere between 30 to 50% price-wise to deliver 7 to 10% returns instead of 3% returns over the next 10 years. 30 to 50% decline it's not just a bear market, that's a crash. So that's a really scary scenario, but the problem with that is you don't know when in the next 10 years that'll happen. And Goldman actually predicts that returns for, I believe, this year is actually, they're not predicting that there's going to be a crash, immediately because of this view. Therefore, it's very hard to kind of prepare for the crash if that's what you're trying to prepare for. So I do come back to, and I say this almost every time I come on the show, and sorry if I'm being redundant, but it's just that important. You do have to maintain balance in the portfolio. Take extreme positions at your own risk, because when you do, and if the event doesn't happen, then that could be pretty bad for you. So it's hard to really play this exactly timing-wise, but it is something that you have to keep in mind and incorporate it into your risk framework, risk management and portfolio construction framework. Otherwise, you could get really burned by taking, extreme positions one way or another.
And I think you bring up an important point when you talk about potential scenarios, because we have absolutely no way of knowing what's coming down the pike, what's on the horizon. So to walk through these scenarios, I think it's very helpful for the viewing audience. And before we move away from this topic, you mentioned a key word there, and that is growth. And that is something that we hear about, whether we're talking about mega cap growth or large cap growth versus value. So can you explain the distinction there? And when we're also walking through these potential scenarios, what does that look like, the whole growth versus value story?
Sure. So growth and value they mean something in things. They have a specific meaning in the investment sort of context. Usually, when people talk of growth stocks, they mean companies that are growing at high rates and therefore often trade at high PEs. And value stocks, they mean companies that are trading at low PEs. But growth is a component of value. If you can buy a unit of growth at a low price, was that a growth investment or a value investment, right? So you always have to be, even as you think about, all right, I want to buy a growing company, you always want to be thinking about, what am I paying for that growth? So they actually go hand in hand. But when you're picking funds, for example, or an index fund or an actively managed fund, usually they'll have, so-and-so growth fund, so-and-so value fund. But I think the more important thing to remember for our audience is that growth is a component of value. And when you think about growth, when you're trying to buy a growing company, you want to be thinking about, that doesn't mean you don't have to pay attention to valuation. You do have to be thinking about, what am I paying for a unit of growth? And for a long-term investor, at some point on the show, I mentioned that to a long-term investor, quality is always important. And growth is also a component of quality. It's very hard to have a high-quality company, and by high quality I mean company that sustainably generates strong earnings. It's very hard to have that if your business is in a decline. So if your business is going to get smaller and smaller every year over the next 10 years, I mean, you might be able to trade that as a stock cyclically, but it'll be probably very difficult for that company to be worth a lot more 10 years from now than it is today. I'm not saying it's impossible. You can do some smart financial engineering, buy in a lot of stock. You can do those things to increase shareholder value, per share shareholder value. But generally speaking, it's pretty difficult. So I do think that for a long-term investor who's got a long-term investment horizon, focusing on quality and thinking about growth as a component of that quality is extremely important.
Yeah, I think that's such an important distinction to make, because when we were seeing the volatility in the markets on August 5th this year, there was a narrative about how there was a rotation into small caps and the Russell 2000. So I think for the viewing audience, it's important to keep all of these factors in mind.
Right, right.
And Dan, we are getting close to the election here in the U.S., November 5th, so less than 2 weeks away. I know that you said on the show previously that you wouldn't place a bet one way or another, but as we continue to monitor the polls here in the U.S., is that still your stance?
Yes, absolutely. You know, the betting markets, Bitcoin, the polls, news headlines, they're all expressing a view one way or another, right? You know, more power to you if you want to place a bet based on that. To me, the outcome of the election, even though every day, you know, we hear, oh, you know, the polls have skewed this way or that way, the betting markets are saying this or that. To me, it's still way too binary for it to be an attractive investment proposition. Now, one might argue that I think it's the general view that a lot of these sort of betting market types or asset markets are pricing in increasingly a Trump victory, and you know, Bitcoin or whatever that may be. Therefore, one could argue that actually, if you want to bet on a Harris victory, it's actually an asymmetrical situation, because these markets are pricing in a Trump victory. But if you think the outcome is actually 50-50, then if you place a bet on a Harris victory, and if Harris wins, then you'll get a bigger upside. Technically true, but I don't think the asymmetry is that meaningful enough for me to find it an attractive investment proposition. So, you know, I still stand by my view that, you know, I wouldn't bet on a coin toss, and therefore I wouldn't bet on the outcome of the election. David Einhorn of Greenlight Capital the other day went on TV and said that the only prediction that he'll make about the election is that it'll be on November 5th, and I will make the same prediction and make no further prediction. But I do want to say that recently, when I was on the show, I talked about the risk of inflation sort of reaccelerating. Whichever candidate wins, it seems pretty clear that that neither candidate is interested in sort of cutting back spending. Both have big plans to increase spending. They both have explanation of how they're going to be able to afford that, but I don't think the reality is going to be that they'll actually be able to fully fund that. And so whoever wins, it seems like they're both highly incentivized to increase the spending by the government, therefore the debt load of the country. And whoever wins, that to me seems rather inflationary. I doubt that whoever wins, I doubt that they'll be able to do everything that they're now talking about doing. You know, I don't think they'll be able to achieve all of that spending, but it's not really, it's a matter of how much will they be able to spend. I don't think either candidate is really that interested in, cutting back, reducing the debt, balancing the budget. Therefore, all this sort of plans of spending naturally is inflationary, and therefore I think that sort of incrementally increases the risk of a inflation reacceleration, no matter who no matter who ends up in the White House after the election.
And before we move away from this, just because when we look at the calendar for the month of November, as you mentioned, we have the election on November 5th, and that is most certainly a certainty there.
Right.
But following the election, we do have the Federal Reserve meeting. They start their two-day meeting right after Election Day, so November 6th to November 7th, with a rate decision expected that day. And of course, the Federal Reserve does keep an eye on inflation. So when you're talking about either candidate in the White House, and if we're looking at an inflationary environment, what would that actually look like for the economy?
Sure. So like I said, the risk of inflation reaccelerating is, I believe, incrementally higher. Does that mean that I'm therefore incrementally bearish? Not necessarily. And this is also why investing is really difficult. It really depends on how much it reaccelerates. So it's not so much the direction that matters, it's really the magnitude almost. In the past couple of weeks, we actually heard from two legends in the investing world, Stan Druckenmiller, I believe on Bloomberg, and Paul Tudor Jones on CNBC. Stan Druckenmiller sort of articulated how inflation reaccelerates. And to be fair, he wasn't making a prediction, but he was sort of describing, if it were to, how it happens. And if you think about it, right now, it's hard to say that financial conditions are really tight. Asset prices of various kinds are all at records, whether it's stocks, gold, Bitcoin, home prices. They're all at or near records. And the Fed is cutting rates into these very sort of strong asset prices. So another way to say that is, asset prices are high, labor market economy still appears to be strong, and borrowing is about to, or has gotten and is about to get cheaper. Those combinations are more likely to be inflationary than deflationary. Therefore, if that happened, that is how a surge in inflation reacceleration happens. And if it happens that way, if inflation goes back up by a lot, I don't see how that would be good for equity markets. Now, Paul Tudor Jones, on the other hand, had an interesting comment, and he too believed that lots of things in the economy, the government policy, and everything also pointing to inflation. But he was also talking about how the U.S. government could get out of that situation, which is a serious problem that at some point will have to be addressed. And in order to, he had recommendations about increasing tax rates and letting tax cuts expire, and reducing spending here and there. But the most effective way to solve the debt problem of the country is by basically growing out of the current debt situation. And basically, if I could use an analogy, like that student loan that somebody takes out in their late teens or early 20s, that was probably a lot of money to that person at the time. Fast forward 10, 20 years, when that person is now earning a lot more money than just whatever money that they were making on their side job as a college student, they're making far more money now, and therefore the amount of the loan is less meaningful, less burdensome to that person. So now, in order for you to therefore grow your way out of that debt problem, you have to have an economy that is growing. And what do you need? What does that mean? You need nominal growth. In order to have nominal growth, you need to have some inflation and some real growth. And in order to have real growth, you do need spending, and you do need support of the monetary you do need monetary policy support for that to happen. Therefore, in sort of the world that he described, and again, he wasn't making a prediction either. He was suggesting that this is how we can get out of the debt problems. In that kind of a world, it seems like inflation, a little bit of inflation is a good thing, because the economy, the Fed would be dovish, inflation would be kind of moderate levels, maybe slightly higher than where it is now, but the economy would also be growing nicely, and all problems would be solved. Therefore, inflation resurging, as I said at the beginning of this question, is not necessarily just a directional question. It's really a question of degree, and what I'm saying is basically it's too hard to know. It's impossible to know almost what the degree or what the magnitude of that increase is going to be. Therefore, it's very difficult to play it as an investor, but like I said earlier, you do have to keep that in mind as you think about your portfolio construction and risk management, so that you're not taking on unintended risks by holding on to certain positions that may be exposed too much to one scenario or another.
And Dan, I'm glad you highlighted some of the discourse surrounding the potential for resurgence of inflation. And speaking of assets hitting all-time highs, one name that we have seen hit recent record highs is NVIDIA. So before we wrap it up for today, give us your summary of NVIDIA.
Sure. So just looking at the past couple of weeks, what I observed was quite interesting. So if you think about the semiconductor space, the first thing that happened over the last couple of weeks was ASML. ASML reported earnings. Its forecast was disappointing. The stock got hammered and sort of brought down all the other names in semiconductor and sort of the greater supply chain, if you will, of the semiconductor industry. And then TSMC reports earnings, and it was quite good, that changed the sentiment of the semiconductor sector as a result. Meanwhile, in the midst of all of that, and in the midst of this, negative and positive, NVIDIA basically just went on and just, continued on and made new highs, as if none of it really mattered. I think what's going to happen, and it has been happening, is that NVIDIA increasingly is becoming more and more about the installed base and the software story, which I've talked about on the show before, and less about purely sort of hardware cycle. Hardware cycle will always be an element of the NVIDIA business, so long as it is selling hardware. But similar to what happened with Apple's iPhone in the early days, which is a comparison that I made on a different episode, in the early days of the iPhone, there were lots of people talking about, this particular phone by LG, it's got better specs, it's got faster chip, it's got better camera, it's a better phone and it's cheaper, or that particular phone made by some Chinese manufacturer is just as competitive. But at the end of the day, iPhone won out, not because it had the best hardware specs, but because it ended up developing an ecosystem, i.e. software, around it. And iPhone became, now specs mattered, but iPhone essentially became the hardware to access that ecosystem. So I think that is becoming increasingly the understanding for NVIDIA, and I think the company is very intentional about making sure to sort of strengthen that moat of the business, if you will. So I think the future, again, is very exciting. The only thing I'll say, though, is, again, high exciting potential means high expectations, so you do have to position it appropriately in the portfolio. I would say, I own it, but I'd say you have to own responsibly when it comes to NVIDIA. So I'll just leave it at that.
Okay, Dan, well, we've covered a lot of ground today, so thank you so much, as always, for providing all of your insight.
Very welcome.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sempro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back bright and early on Monday morning. Have a great weekend.